Last number too, 6:01 in the minutes.
Oh,
No.
very nice.
Clean it up there.
Okay, it's still 6 o'clock. You
Yes,
ready?
we're ready.
Okay. I'm gonna call the meeting of the pension board for March 11th, 2026 to order. And we're gonna start with a roll call.
Jim Hendrickson here.
Charles Pirow. Bob Raleigh. Frank Nash.
Dave Kramer. Kevin Schmidt Cowan.
Tiffany Lamb.
Minutes from, acceptance of the minutes from February 11th.
One minor, I'm sorry, this is on the. Never mind.
Is there a motion to accept the meetings, the minutes as,
Jim Hendrickson makes a motion to approve.
the second? Bob Raleigh. All in favor?
Aye.
Opposed? No. Any public comment?
I don't see any hands up.
It's good to see Eileen here. Hello, Eileen. Yeah, it should probably be in the minutes of, it should be in the roll call that Eileen is here, okay? On Zoom. Okay, we have one pension application. So, is anybody on staff gonna discuss this pension?
Do not see. So Darren.
We haven't had Sharon on to discuss the pension in the last few meetings.
I know, which.
Yeah.
It's a little disappointing that we don't have a person on staff to discuss the pension. I mean, it might get tabled again if we don't have a discussion. There's nothing different on it, on the application.
I guess we want to know, was there a reason for the delay in the filing, right?
Correct.
Maybe Sharon join so we can get this done. May not be prepared to answer the question, but anyway.
I did send an email. And I said on the email that the reason why I don't see anything here that is changing our reason previously. This is
I know there's a hand up and that's Larry Manzi. Would you like him to speak?
pardon?
Larry Manzi is one of the public guests and he has his hand up.
Sure, if he could talk to us, but still, I mean, it's
Yeah, we can explain what our policy is then.
right.
So I'll give him the floor.
Yep.
Hello.
Hello,
Hi, can you hear me?
Ken.
Yes, we can.
Yes, thank you, Frank. I don't know if you remember me, Frank, I was on the pension board back when Hugh Murphy was running the board. I represented NMEA. I was the president of NMEA. But anyway, I spoke to Sharon. She emailed me today and said she would attend. She would be there to explain. I've sent her information. I've spoke to Liliana. The long story short, I moved 3 times since I retired. I'm in Florida now. I'm a Florida resident. I didn't get the final packet that was correct, that had my correct address, until late December. Personnel sent it to me on December 22nd and mailed it to Florida. I don't know the exact date that I received it, but it was late December. So I filled it out. What took probably in one more month was close to a month was a marriage certificate. the town I got married in doesn't allow you to get it online. I needed, for the packet, I needed a certified marriage certificate. So they only accepted a certified check. So I had to mail them a certified check. Then it took them a few weeks to get my certificate back. So to answer your question, that's long story short. I could get into more if you want, but the other thing is, before I left, personnel's very shorthanded. I mean, even when I retired, they said um, they've gone through 3 different benefit managers, and I don't believe they even have one now, a full-time benefit manager. So even when I retired, I was told that it may take a while. Um, so that's I don't know if you have any questions for me, but that's
Yeah,
Okay.
yeah, Larry, it's Jim Henderson. So what conversations did you have with HR when, on your last day, which I guess was September 11th, is that correct?
yeah, my last day, I said I'm gonna put in for my retirement, because it's not like I'm retiring at 50 or leaving the city at 50 and then waiting till I hit 62. I have I have 36 and a half years and I reached 62. So there's no benefit to me to wait even another day to start collecting my retirement. I get my full retirement. It's not the case where someone left early and then when they hit 62, then they waited to file or something like that. So to answer your question, on my last day, um, I met with Liliana personnel, and she's the one that told me it may take a while. We're shorthanded, and I believe she was at that point, she was doing everything. You had a personnel director that was maybe part-time. She was working full-time somewhere else. You didn't have a benefits manager, and Liliana was kind of filling in on all those things. And believe me, she did a great job. She's overwhelmed, I'm sure, but hopefully personnel's been, I don't know. Since I left, I don't know if they've hired anyone else, but
So,
I was told it would be retroactive. The form says it's retroactive to my date of retirement. So I understand your concern. Why did it take so long?
do you know when she sent something out, even though it might have been to the wrong address?
She sent out more than one packet. She sent one out, I believe, maybe 2 months later.
That was the first one, 2 months later?
Yeah, I believe so.
Okay.
Okay. When I knew I was going to retire, months before the intended date, I gathered the document, marriage certificate, whatever else I needed. I had everything ready. So on the day of retirement, the next day I filed I had filed actually Social Security applications even before I retired. Everything else as of the time of retirement, I have everything ready. So I have a problem with an excuse saying, well, after my retirement date, it took me a couple of months to get a marriage certificate or something else.
No, it didn't.
Anybody who knows they're going to retire has all that stuff ready to go.
I didn't know I was going to retire. The house I was living in got sold, and it would have been a very long commute. So I put in my resignation. I wasn't preparing to retire. I had to be out of that house in about a week. And I moved to Florida. So I moved three times. It wasn't something that
I appreciate all of that, but
yeah.
I've defended an awful lot of eviction cases. If somebody sold the house you were living in, they had to evict you in a process that would have taken at least several months.
Yeah. No, I was living with
So
my brother, and
you could have
I wasn't
continued.
evicted.
I'm sorry.
It wasn't an eviction.
I said it could have been an eviction. You could have stayed there for several months, continued working.
It was
obtained all of the documents.
it yeah, there's a lot of ifs, a lot of possibilities, Charlie.
No, it's not a lot of possibilities. It's a lot of options that were available that you chose not to take.
Okay,
And
but
our policy has always been that unless there is some compelling reason to deviate from our precedent, we grant applications as of the date of application. And we've been doing that since I've been on the board for 38 years.
I could have post-dated the application. Charlie, I didn't receive the application.
The application is, don't tell me that, because then we're really going to get into a bad area.
Yeah,
I
understand. Charlie, I didn't receive the correct application. Also, there were 2 forms that were missing from the application because the first
all that stuff beforehand. You could have
Well,
stayed in that house long enough to get all those documents.
How can I get those documents when
you got all the documents and then put in a retirement and got your pension as of that date? You chose not
exactly
to. You chose to
exactly
vacate the apartment and apply afterwards, but that's fine. That's your choice. And I'm not saying it's good. I'm not saying it's bad. I'm saying that was your choice. But our precedent is to grant an application as of the date of the date of application, and not some previous date, unless there's some compelling reason. To my knowledge, I think we've done it twice since I've been on the board.
Yeah, Charlie, I was on the board for like 8 years, and I've seen all kinds of applications. In fact, recently, in the last couple of years, I've even seen it where an application wasn't filed for many more months later because of personnel, and it was approved by the board. I'm telling you, I didn't get the application till late December. It was mailed the 22nd. I'll have to look at the date that I got it, but say I got it December 27th. I had the application back. I had all the information in January, and then you had the February meeting.
Yeah, again,
so
my problem is you had the ability to get all of that information beforehand. And you want to blame the pension board, you want to blame the city office for not sending you the documents when you could have obtained them yourself.
Well,
I mean, I don't want to blame the city for not sending you the right documents. You could have gone to City Hall and gotten them.
Charlie, I live in Florida. I live in Florida.
Prepared everything, filed it, and then moved to Florida. You had the right to do that under the law.
Well, yes, but
Mr.
understood.
Mr. Manzi, you said that you've seen a number of pensions, if I heard you correctly, that were filed and they're retroactive to payments.
I recently, when was it? I'd have to go back and look at the meeting, but I saw one where personnel did not file it, and for several months after the person put it in, and personnel said, "Oh, it fell through the cracks."
Well, but if somebody put it in, then we're going to grant it as of the time they put it in. That's the date of application. Same thing for you. Whenever you put it in, that's the date of application. I have no problems with granting it as of the time you put it in.
Well, I was waiting for the forms. I can't put it in until they give me and do all the calculations. I can't file.
We're going around in circles, but you could have gotten the forms before that. You didn't have to sit back and wait for the city to send you the forms. You could have gotten them. I mean,
no, they have to send it out to the
most people who are going to retire go and get the documents.
Yeah,
Mr. Manzi,
yes,
Mr. Manzi, did you give like a 2-week notice that you're going to retire?
I did.
Did you go to the city hall during those 2 weeks and get the documents?
No, I went to City Hall on my last day. I was working my last 2 weeks. My last day, I met with personnel. They told me it's going to take a while. They don't have a benefits manager. They had to,
Did you
they
file
have,
the application as of that date?
no, you can't file the application because you don't have all of the numbers. You don't have all of they said it's going to take a while to get you the paperwork. You can't just get the paperwork. They said it's going to take a while because they have to send it out to a actuary lawyer that's going to review the numbers. So the packet that they send you, I did not receive the full packet until late December. That's what I'm telling you.
You're saying you had an attorney advising you during this whole period too?
No, I don't have an attorney.
Wow.
Anybody else have anything? Do you have anything, any questions?
No.
Any questions?
No.
Okay. Any other statements you'd like to make, Mr. Manzi?
Let's see. Yeah, no, that's just it. The packet came to me, and actually there was a difference between the first packet and the second packet. The packet that was sent the second time was missing documents. Actually, the first time was missing documents. So the packet that came second had some additional documents like tax documents and things that I also had to fill out. So I didn't even receive the full packet the first time. I had to go through both packets and determine what were all the required forms.
We're gonna go into an executive session. And I do believe that would be, we unfortunately, although I did communicate with the city. We don't have anybody here to explain the situation. From the city's perspective. And as a result of that, we're gonna go into executive session and have a discussion. But I appreciate your logging in and giving us your perspective of this, how this evolved.
Thank you. One last thing. So I've had no income from September. Now I still don't have any income, and now it goes another month. It's just to show you that personnel is very shorthanded. That they and that's part of the problem.
Okay, thank you for that information.
The executive session, not yet.
Executive
Yeah,
session.
session.
There you go. They could hear us now.
Eileen? Hello,
You're on, Eileen.
mute.
You're on mute, Eileen.
Yes, what?
Thank you very much. First of all, I'm happy to see you at the meeting.
Okay.
Remote, I hope you're well. What did you think of, were you able to hear Mr. Manzi?
Yes, I did. I heard every word he said.
How did you feel?
Well, I think people know,
Not in executive
I think
session.
people know when they're gonna retire. They normally will plan for it. He didn't state anything that said it was a surprise retirement or anything that happened that it was all of a sudden a retirement. And I agree that he should have been prepared. he should have collected all his documents and everything else before he moved to Florida. I really agree with that because especially if you're relying on the money, like he said, for each month, you're going to make sure you have all your documents filed before you leave the state. I mean, that's how I feel.
Good. I appreciate your input. We're gonna go into executive session. If we
Mhm.
want to have you on executive session, if you want to join us, although you have given us your opinion,
Right.
okay? If you would like to continue into executive session, I think we have to do it on a telephone.
Yes.
Yeah.
Do you want to do that, or would you have faith that we will make a good decision in executive session?
Well, I'm sure you'll make a good decision, but I wouldn't mind coming to the executive session too.
Okay, good. Do you have can you,
Let me.
let's see how we're gonna do this. Who's the guy who was in here before?
Rod, do we have a phone?
I got my phone.
Well, I'm sure you don't want your phone number.
Yeah.
Let's see. Hold on one second. Can you email me, Eileen?
Sure. What's your email?
clam@norwalkct.gov.
Okay. Now, do you want me to email you from my phone?
Yes.
Okay, hold on. I have to get my phone then.
No, we just need your phone number. Oh.
All right, I'll give you my phone number.
Well, no, if you could just email it to me.
Okay.
Oh,
All
yeah.
right. Uh-huh.
Your email is Clam,
Yes.
and this city is known for oysters. A little against the grain there, lady.
It worked out perfectly.
We're back on. We're discussing an application for a pension. For Mr. Manzi, and there is a motion, or is there a motion regarding the pension?
Yeah, this is Jim Henriksen. I'll make a motion that we approve the pension with the payments effective as of the date of the application. The application was signed with the proviso that we will discuss it further with HR when we have the appropriate people available, and we'll make a decision as to whether or not a retroactive payment to his last day of employment is appropriate.
Is there a second to that?
I second Robert Alvin.
Any further discussion? If not, all in favor?
Aye.
Aye. Opposed? No, passes unanimous. Excellent, thank you. Next is reports, performance review.
Or do you want to, I guess we have to finish.
Yeah, we have to finish.
Yeah.
Pension, yeah, well, thanks, everybody. I know, Britt is virtual, but he's gonna give a little bit of a market overview for the January pension report. I'll dive into a little bit of performance and we'll go from there.
Perfect.
Great. Nice to see everyone. Sorry I can't be there in person. So in January, we saw equities up, Russell 3000 up about 1.6%. As you know, we've obviously seen a sell-off in markets since the war in the Middle East. So I thought I'd give you more of a, as of yesterday, update, given that we have January performance and a lot has changed since the end of January. The S&P 500 is down about 70 basis points year to date through yesterday. In the US, we have seen value significantly outperform growth to the tune of about 700 basis points between large cap growth and large cap value. Similar story across the cap spectrum. Internationally, international equity continues to perform very well. The MSCI ACWI XUS up about 4.9% year to date. We're seeing small cap and value stocks internationally lead returns. Within fixed income, year to date up about 77 basis points. Month to date down about 1%. So we saw a strong February, but a bit of a sell-off so far in March. So given that backdrop, obviously there's a lot of volatility in the markets. This is a time when we really preach asset allocation and sticking to that asset allocation through rebalancing as necessary, and not making any significant moves within the portfolio. With that, I'll turn it over to Kevin.
Yeah, thanks, Britt. We'll keep these comments somewhat tight. I know we just went through a fair amount of pension performance at last month's meeting, but if we're looking at page 1, just in terms of the assets themselves, so the total fund had a net gain of approximately 11 million in January. Britt kind of alluded to this, but the drivers of the return really came from various parts of the portfolio for fiscal year to date period ended January 31st. Most notable absolute contributions were from international equity that was both developed and emerging market, as well as US equity, and then finally from the real assets portfolio. For that fiscal year to date period, in the black, ahead of the custom benchmark, which is great, by about 40 basis points, let's call it. I think things have gotten a lot more interesting, as Britt alluded to, and we are seeing active management really kind of add some value. So in the coming months, as we review things, it'll be really interesting to see how our particular managers did themselves. I've heard international managers in the last couple of weeks adding 3 or 4% on a relative basis, as a result of what's going on in Iran and the Middle East, that area. But focusing on January, positive month across the board. Again, there are some pain points still we talked about at length last time with Walter Scott on a relative basis for that fiscal year to date period. LSV on the domestic value side. Both are having some headwinds, but also stock selection for each manager has been poor, let's say, to say the least. But really strong numbers coming out from BlackRock in particular, as well as PIMCO All Asset Fund. We're seeing better numbers coming from TCW MetWest, the Core Plus manager. Their duration bet, even though they've taken it down, they still have a bit of a duration bet, and that's been a tailwind for the last 12 months or so, finally, when it was previously a headwind. So again, contributions coming from across the portfolio, which we always like to see, to get that diversification. Questions from anybody on?
Good.
Nope.
Okay.
IPS review.
Yeah, so we did put the copies of the IPS in the materials here. The first, and this was at the request of Jared to add the language around CITs and commingled funds specifically, just to really, the legal had asked us to call that out. So, sorry, give me one second. Page 10 of the IPS, the pension IPS, you can see, I mean, it's like half of a sentence. We've redlined it here. This is the redline version. So, Frank, this is in section 2, page 10. For those who have the hard copy. And again, I'll just read it out loud. So the first part of the sentence said, in addition to separately managed accounts, the city of Norwalk may be invested in one or more commingled funds. And then what we added was including but not limited to collective investment trusts, mutual funds, and other pooled vehicles. That was the extent of our change, as well as then just updating the date on the front of the IPS. And that should cover what was being requested from legal.
I had a question on page 14 also. Didn't really have a chance to get back to that.
Yeah, I don't know if anybody had question or comment. Obviously we need to approve that change, but do you want to answer your question first?
Sure. On page 14.6, it says foreign securities, including foreign stock listed in US exchanges, and ADRs are limited to 20% of the portfolio. And our target, I think, for foreign investment is above it, 28%. Is that, am I reading it wrong, or how should we read that? So page 14.6.
Foreign securities.
That is under the US equity tab.
Yeah.
So
Right.
there will be US equity managers that hold stocks that might technically be domiciled somewhere else, but their business and revenues are generated in the US.
So
So
that only applies then, you're saying, to US equity.
Right.
only-
Exactly.
Below it is non-US equity guidelines. Which gets to your point about an international portfolio will hold more than 20%.
20%, yeah.
Right.
Yeah, so we're saying that this only applies though to.
Yeah, if
US equity managers.
if you flip to the prior page 13, subheader A, US equity manager guidelines. The page breaks might be a little confusing,
Okay, all right,
but that's where it falls.
that's why it falls there.
Yeah.
And I think it's important to note that these investment guidelines only apply to separately managed accounts. So if you invest in a pooled vehicle like a commingled investment trust or a mutual fund, their investment guidelines will override these because you don't have the ability to change them.
Okay, I can live with that.
I also had one quick question. This is under the investment manager section 5, the last sentence in paragraph B. The pensions percentage of any firm's assets under management shall not exceed 5% without board approval. Do Callan's
Measure that.
system track that?
Sorry, where are you?
5,
Well, do you know what page it's on
I'm on the
Page 7.
page 7? Thank you.
section 5, paragraph B, the last sentence. Do your systems track that? That we're not over more than 5% of many managers' book.
So every manager, yes,
Yes,
we
we do.
we have that
So,
information. Every manager you utilize is a huge asset manager.
Yeah.
We
Even Principal,
Yeah.
who very small, Principal as a whole is a very, very large asset manager. So the concern on that front was the strategy and how concentrated
Yep.
their client base was. But as a
Yeah.
larger organization, you shouldn't run into any issues
Yeah.
with that.
Okay.
Yeah, because it's part of any of our searches too on the front end.
Yeah.
I did have a couple points, actually, the same thing on page 7. And the amount of fund shall have a minimum 500 million. Are we close at all to any of the funds that we have that are at near 500 million? The very first sentence in
The only one was Principal who's been terminated.
Okay.
Okay.
And then should we change that number? Or is that reasonable to keep?
I think it's still reasonable. I think it's a good barometer, and the idea being that when we do searches, managers are well beyond that, and we're tracking flows. Like in the case of Principal, that was a big concern, was the amount of outflows, and we brought it to light before it got near to that 500 million. The truth is that managers can operate way below that. If you talk to managers in terms of like keeping the lights on, it's sub 100 million. But it leads to exit of investment team members and everything else way before that, which is kind of why we have that buffer beyond just where they break even, let's say.
I guess another way to put that, Frank's question is, if we've had that number for 10, 15 years, should it be inflation adjusted?
Right.
Uh,
I don't know.
Yeah, because we've had it for quite a while.
It's a fair question. We could probably take it back to our manager research team just to see if they have any thoughts on there.
And the only other one was In the same paragraph, it says investments in any fund shall not exceed 10% of the fund's assets without board approval. I would think 10% is a high number. If you have a fund that had 500 million and you had 50 million in it,
Yeah.
theoretically, and you want to get out, you're gonna have trouble.
It's client to client. I work with a super large public pension plan that they're going to be limited in terms, like really limited in terms of what they could invest in. So they are willing to go much higher than 10%, but like for you all, 10% might be, too much. So it kind of depends in that.
But they might have $30 billion and we have 600 million.
They have 270 billion. So like their ability to cut checks. Right. So that's why I'm saying it's totally dependent.
You can't, I don't think you can compare them to us. What I'm saying is,
Right.
we could have $50 million in a $500 million plan. That to me, I think would be excessive. That's all. I don't know if
That was my point, that it's
For us,
committee
it
to
could
committee
be
board
excessive.
support. Right.
right? So what do you guys think?
I'd be interested to see, what the data looks like. I don't know if that's an easy report for Alan to generate. Here's our manager list, here's their total AUM, here's our percent of that, here's, what
We can,
10% would
that's
be.
pretty easy.
Yeah.
Honestly, for us to look at your managers but I think it still comes back to the comfort of the board.
Mhm.
And that was kind of my point, is that some boards will say, or committees will say, because of our size or limitation, one way or the other, we're comfortable with being a higher number, or in your case, you might say, no, we want to stay lower.
Does it matter if it's commingled or not, too?
Yes. Commingled funds, CITs, they're their own unique aspects, like CITs, if you're one of two investors, you're carrying more of like the operational and administrative costs, and those go down as other clients are brought in versus a separately managed account where right?
You are.
Yeah. So it does matter for everything.
And these thresholds are on the firm level or the vehicle level? Like the 500 million, is that the vehicle we're in, or is that the whole firm? Because that's, I don't know.
I read the 500 million as the firm level,
Okay.
and I read the 10% as the fund level.
As the strategy, but not necessarily the vehicle.
Mhm.
One last thing, page 13. Where it says naked commodity futures contracts. The only thing is, we don't have any money in commodities now. Right? To me, kind of the horses
All
are,
asset fund.
that ship sailed.
Mhm.
Nobody listen to me, mine gold. Anyways.
If all asset fund was just from commodities?
Well, I'm just saying that if we did eventually someday want to put money into commodities, I would think they would have commodity futures in that.
Yeah.
Right,
Hedge that way.
pardon,
They would hedge that way, and they would.
well, that's how they would put their long positions on, or in fact, if you were in a fund.
Mhm.
A commodity fund most likely has, some commodity funds have futures.
And Frank, maybe as a reminder, if you look at page 11, showing the asset allocation table.
Right,
at the
where
bottom.
we're at zero.
Correct. But
Commodities, right.
when the board decided to eliminate infrastructure, there used to be private infrastructure in the portfolio, and eliminate commodities. The stance was make the target zero, but leave it in case we decide to go into this asset class in the future. Alternatively, we can certainly remove reference
Right.
infrastructure.
Our target right now is because we have no money there, but we could put money into commodities because we do have an upper limit of 5%. Right, so we've kept it in there. We've kept it in the asset allocation list because in the future, if we wanted to add commodities, we could have up to 5%. And that, I'm just saying that some of that would probably be in futures.
Yeah.
That's all. I mean, it doesn't have to be changed now unless we decide to put money in commodities, but just a point. Right? Because we have had money in commodities in the past. We don't have money there now.
So should we approve this one little change?
Yep, we're gonna.
If there's other couple
And the other things that you guys can. We're fine with, if you,
I'll make a motion to approve the change to the investment policy strategy to accommodate investments in collective trusts and as noted in the revised document.
Charles Pearl, second.
any discussion? All in favor?
Aye.
Opposed? No, thank you very much.
Jim, we can, if you want, we could take a look at that, the 10%.
Yeah,
The fund levels of the
I'm just
strategies.
curious where we were.
I think we can get that pretty easily.
That's an easy report. It'd be interesting.
Yeah, okay.
And like you said about the 500 million, this thing goes back 10 years ago.
At least,
Should that be a little higher?
at least 10 years, I think.
Yeah. So maybe you could look at that also.
So sorry, what was that last?
Take a look at the 500 million threshold.
Oh,
and
yeah,
see if
we'll
you should-
talk with,
was probably
the
down
research and.
When the S&P was 3,000 or something.
Yeah, fair enough. Okay. That concludes everything we had on the agenda for pension.
We got a request.
If the mayor requested.
Thank
one.
you. Please, guys, yeah. Chitsame, do you wanna
Yes.
give a little background?
Explain to us why you need so much money.
When you're going on vacation.
So as you can see from the report, we draw down the net amount of almost 3 million, and that's to pay our retiree the benefits. And this is for pension, but as for OPEB, I think we draw down close to 1 million each month. So now that our cash is a little low in those two different funds, I would like to request from the board to raise cash of 10 million for pension and 3 million for the OPEB.
You know what, should we first vote to agree with that and then decide where the money comes from? Should they be two separate things?
Can't hurt.
I don't know what's the point of any I don't care. Any value in that.
Please, I'll move, we take 10 million from pension and 3 million from OPEB. Is that right?
Yep, OPEB.
I was thinking
It's
about
all zero, get a motion.
All in favor?
Aye.
Opposed? No, thank you. Okay, now we gotta figure out where we're gonna get the money.
Yeah, we put together the two rebalances here, pension, the first one. And as you know, we always do, we're trying to pull each of the current allocations closer to their targets. On an absolute basis, both US equity and international equity are over target by 2.3%. And you know what that means is that international on a relative basis is a little bit more overweight. So we opted to recommend taking the dollars from the international composite, and Britt, keep me honest here, but we're recommending taking it all from Silchester because of the large overweight from a structural standpoint. That Silchester, who's the value manager within the international equity composite, again, large value overweight versus growth. So we're going through a structure study as we speak, which we're going to present to the board next month. And some of our work has to do with addressing that overweight and bringing it to a little bit more of a neutral stance. And so this kind of helps us get into that recommended direction. But happy to hear comments or thoughts from the board.
You know, there's a thing about in investing to me is you cut your losses and let your winners run.
Yeah.
Right? So let's see, in that environment, we have one guy, he's up 19.4%, the other guy's up 3.5%. So it seems that one has done much better than the other. So we're gonna take money out of the one who's doing well and leave money with the guy who's doing poorly.
Well, that doesn't make sense.
Thank you. I mean, could you, okay, if you want to take, I'm not saying, you know, take it out all out of Walter Scott or something, but should we divide it a little bit out of there? If you want to, I'm not disagreeing if you want to take money out of developed markets, that's fine. However, why do we, I mean, if Rich was here, Rich was the one who consistently told us to continue to put money in Silchester, if you remember. And Silchester's performance has been excellent.
Very good.
I mean, they have so much because they've done so well.
Historically, what we did was take money from Zesiger regularly.
Right.
Well, he's gone.
We don't have him
We
anymore.
don't have him anymore.
No, but because he was making so much money, we took money from him. And what we're saying here is because Silchester is making money, we take money from them. Historically, that's what the board has done. I don't think that's the best approach.
Right, and the other thing is, we didn't have anybody who was really like a Zesinger at the time either. He was like an outlier, right? So that was a whole different ballgame. And that's before we had the gentleman we have now.
Yes. Yes.
If we look at Silchester versus the growth manager, Walter Scott, there's no question that Silchester has done better. Silchester versus their benchmark is under, and they're about median on a peer group level when we look at the quarterly reports. That's something that we're, you know, so
1941 versus 2239, you're saying?
right, that's under.
Yeah.
So they're under, so even though
They're not, okay, but they're under by 3%, all right? And Walter Scott's under by 10%.
I totally agree. That's why I stated the comment that compared to the growth manager, they're doing much better. From our standpoint, though, we always start from the asset allocation and the structural level. And so what would happen is if we pulled even a little bit from Walter Scott now, the structural work that we come back to you with next month is going to pull that much more from Silchester because we're trying to create more balance within. Like the risk is off kilter right now because of this really large overweight to value.
Yeah.
And it's Callan's just historical stance that we want to try to create as much neutrality as possible from a structural standpoint so we're not getting unintended risk coming through.
Right, but that could be for another discussion, because when you talk about having growth and value, maybe have an ETF and let the ETF do the balancing for us, right?
Absolutely. And we're looking at options like alternative options in the structure work that have a passive component where if that's the case, we can, look at that alternative mix. Britt, anything you want to add?
No, I mean, ultimately, it's the board's decision. I think, the international portfolio was set up to have a growth and value manager equal weighted. And obviously, the current allocations to Silchester and Walter Scott are not equally weighted. That being said, the other place that we have consistently tapped for cash is the BlackRock Russell 1000 index. You're also overweight to U.S. equity, so you could potentially take the funds from there.
What about doing, all international, instead of taking it all from Silchester, take some from Walter Scott? Say 7 and 3 or
5 and 5 or
5 and 5.
We can do that.
8.
Again, like the structure work though, it's gonna like
Yeah,
add it,
I
it's
prefer-
gonna recommend adding it back. You don't have to follow our
Would you prefer
recommendation.
5 to 5, 5 to 5.
I prefer 8 from Silchester, 5 from Scott. We need 13.
Oh, no, we only need 10 out of here. We gotta take the other money out of
The
the
other, okay,
Yeah.
all right, and 5, 5.
What do you think?
I like that myself. I mean, I don't have a problem. You know, obviously Silchester's been very successful. But also right now the market has been this, the value market too, right? It has really been driving this thing.
It's been a value market and Silchester's also going, in part of our work, we recognize they're going even more deep value as of late. So that's pulling things apart more. Again, Britt's comment, it's the board's decision. I just would, if we come forward with recommendations, at least some alternatives next month structurally that are saying you need to add to the growth to sell now only to potentially add back.
Right on.
Yeah, so I just say that as information, not the board can do as they choose, obviously.
Well, my view is since we're overweight on both US equity and international equity, and US equities a much bigger total investment for, I'd go at least 5 out of the Russell and maybe the other 5 out of Silchester.
Well, they were talking about that, oh, we're not that overweight, are we, in US equities?
It's the same absolute. It's
2.25%.
Yeah,
Same
Same
percentage
now.
overweight, bigger dollars in US equity.
right.
BlackRock is value on the US side.
BlackRock is the passive Russell 1000 index. So that's more of a like core.
Yeah.
LSV is the value.
What do we think?
Well, I kind of like US stocks better than international, you know, right now, personally.
International did better last year, right?
Yeah.
Last.
I mean, and one of the things I'll say for Walter Scott, they're way underweight, the financials. And financials are under a lot of pressure.
Yeah.
You know, that is one thing, you know, if you look at like the bank index,
Yeah,
you know, they've been under a lot of pressure lately. I mean, you know, it's not a big deal to take money, is it? Right? I mean, if we said 4, 4, and 2 or something like that.
No.
No,
Fine with that
you
too.
want to do 4 out of the Russell 2000, 4 out of Silchester, and 2 out of Walter Scott.
Sure.
Everything's fine.
Is that okay?
Yeah.
Sounds like a plan. Yep, let's do it.
Hunter, you can make a motion.
All right, make a motion.
All right, I propose that we fund the retirement benefits required by the controller. We reduce our holding in the Russell 1000 by 4 million. We reduce our holding in Silchester by 4 million and Walter Scott by 2 million.
Charles Perrow,
So
second.
a second. Any further discussion?
No.
All in favor?
All right,
Aye. Opposed? No. Perfect. Is that good? Rick?
Great. I think we just need to do OPEB because there's no OPEB meeting.
yeah.
You already gave the rationale to Samay, but
Where's the, oh, do you have
it's
a?
the second handout.
Yeah, 1 page, Aaron.
Yeah. And
One second, I need to say one thing.
oh, sorry.
Oh, there they are.
Yeah, start with that.
We can make it around the table. There we go.
You got one good.
This one, hopefully really straightforward. Again, just kind of looking at international in terms of like where the current weights are versus the target weights. And so the recommendation is to take the entire 3 million from the Vanguard Total International Stock Index,
Yep.
which is the passive, in order to bring that overweight down
27.2.
to 27.2. Right there, it's a little over 29 right now. The target's 27. So
Yep.
Straightforward.
Looks fine.
We need to adjourn the meeting and then call the open meeting to be able to do that.
Oh, yeah.
Okay, so why don't we,
Nothing else for the pension.
okay, so we're gonna do, well, actually, we don't have technically an open meeting this week. We have a, refined contribution. But we could,
Right.
right, so, and I think what we did was we did it within the venue of the general meeting last month.
If we have it back from.
Right, so why don't, maybe we could, because we're talking about the distribution of funds that's controlled by the pension board. If it's okay, Charlie, we could just say this is a distribution of funds from the pension board, then we don't have to go out and. Sorry, Charlie isn't happy. I like Charlie being happy. You know, would there be any so take 3 million out of the international equity, is there any discussion on that? And if not, is there a motion?
I'll do a motion there to move 3 million out of international equity for the OPEB fund and move it to cash for Chitney's vacation.
Second that.
All in favor?
Aye.
Aye, opposed? No. Perfect, thank you. Any other business?
Move to adjourn, girl.
Second.
All in favor? Aye, excellent. Okay. 7:13, I gotta go fast to find contribution.
Did we get them in first or?
Yeah, I mean,
Yeah, bring them in.
Yeah.
Correct.
We'll do the minutes and all that stuff.
Well, you're going to get them, we're gonna go, we're gonna do the roll call. We're gonna call the meeting to order, they're going, okay?
Yep.
We're gonna call the meeting to order. Roll call,
Jim Hendrickson,
Charles Carroll.
Frank Nash,
David Prayer.
David Kramer. Acceptance of minutes from January 14th, 2026.
I'll make a motion to accept the minutes.
Second.
Any discussion? All in favor? Aye.
Aye.
Perfect. Do you have a public comment? What? No public? All right, excellent. Now we're all ready for a report.
yeah. 95 corridor, right?
Yes, yeah.
Hey,
doing?
hello. Good.
Maybe
Everyone.
David and I can swim around and have them sit here, is that?
Yeah.
Is that okay? All right.
So where do you want?
You tell me.
Yeah, we're for you guys.
Is it?
Very easy.
No, we want you to both stand because we have some tough questions.
Oh, I love it. Give it out all the tough questions and I'll take the easy.
Yeah, thanks.
Happy to stand, but.
Oh, that's fine, that's fine. Oh, yeah, okay, perfect.
All good. Okay.
But you came back because we voted that you were here.
David, you want, I swung you around here. if that's
No problem, no
okay.
problem.
Yeah.
Yeah, that's just, absolutely, no problems.
Thanks.
Carry these down from Boston, so I want to make use of them. We can.
Have to carry me back that way, right?
Oh, no worries for it.
Hey, all right, keep that waiting.
No problem at all. Thank you so much for having us here today. And thank you, Cal, for inviting us. We appreciate it.
Absolutely.
My name is Adam McCloskey. I'm a relationship manager here at Capital Group, specifically focused on our relationship with you all in the city of Norwalk, Connecticut. I'm joined by my colleague, Deb Bent. Deb is a multi-asset investment director at the firm focused on our target date suite of strategies. So happy to have him here today to answer all of your questions. Before we go any further, I just want to thank you all for the partnership. This past February marked 6 years of working together. So we really just appreciate your trust and support over that time, and I'm looking forward to working with you going forward. I'm talking to Britt and Kevin for, I understand, about 30 minutes.
Yeah.
Today. Yeah. Okay, perfect. So I thought what we could do over that time was provide us with a quick refresher on the strategy, objective, and process team before getting into the glide path and focusing on results. But happy to go in any direction that makes the most sense or is the most helpful for you all.
Sounds good.
Maybe just in the interest of time, I'll just a quick update on the firm on page 5 here. If you look at the bottom right donut chart there, you can see as of the end of the year, we have the privilege of managing about $3.3 billion for clients around the world. About 430 of that are in our suite of target date funds, which is an area we continue to see a lot of interest and flows from clients and consultants. Results continue to be really strong there. Maybe I'll just stop it there in the interest of time, but happy to answer any questions on the firm before I turn it over to Jeff.
So
If we didn't think you were a good firm, we wouldn't have you here.
I'm happy to talk about how great we are. But,
So just get going.
perfect. With that, maybe I'll turn it over to you, Jeff.
Yeah, how about we, and by the way, it's always great to be back here. I think this is maybe my fourth consecutive year, third consecutive year. So it's good to see the bunch, and I know you all are an interactive bunch. So maybe even before getting into the our story, there's some questions you just want to tee up, and maybe I can weave those into my commentary. And maybe we just kind of start with the questions, and I'll kind of sprinkle them throughout our update.
I do have questions, but does anybody else have questions?
I'm looking at page 24 in the slide deck. Just a glance at that.
And I'll write these down as well. So slide 24. Okay. So the downside capture chart.
Yeah.
Okay. Spend some time there.
Couple things I was wondering, you said a glide path and like you have it changing at retirement, okay? That's on page 11. But nowadays, somebody in the city say could be retiring at 55, or somebody can be retiring at 65. And you make adjustments for that. And also, the idea that there are tables that show that life expectancy in Connecticut is higher than the national average. You take that into consideration, and also along those lines is, the sex of the person retiring, because women live like 5 years longer. So would that mean that you would say, even though the on the retirement date where you have really a small portion in stocks, that you would maybe bump that out? Because somebody could be retiring at 55 and be living to 85. And that seems like that span would be a time still to be invested in stocks. So that's what I was trying.
Okay. Demographics, anything else? I'll be sure I hit those on your list.
Anybody, you got any questions? Anybody?
So the download thing, I just.
Yes.
Yeah, good.
If you can just talk about the glide path review process and any changes recent or anticipated to the glide path, that would be great.
And my question on the downside capture was, just a little discussion on 2022.
Yeah, only one other thing around rebalancing. It's more of an issue for passive target date fund providers, so maybe less so for you all, but if you can just kind of restate the frequency of rebalancing the portfolio itself, the target fund itself versus the custom index. Because sometimes, right, if there's like a mismatch. Yeah.
All right. Really good. And I always like to start there, especially with more interactive committees like you all. So I won't spend time on the team because you all hired us for a reason, right? We know that. The only thing I will share is our lead portfolio manager is once again recognized by the publication of Morningstar being one of the top portfolio managers in all of asset allocation. That's Michelle Blackline, my good friend and colleague who leads the effort for supporting our Target Date franchise. What I will share is let's kind of start on the glide path. So if you go to slide number 11, I will answer your question in terms of like how we think about the portfolio construction process. And by the way, I do remember you weren't here last year, but I remember your question from 2 years ago around this idea of demographics. So the most critical component of our glide path construction process is understanding who we're solving for, and that's the participant. Now, when we build our glide path, we don't necessarily build it for individual municipalities, individual counties, individual states. What we do is take an aggregate of our 1.5 million plan participants on our own record keeping platform. We look at eBreeze data. We also look at, the 55 million census records. And then ultimately we formulate a demographic profiles for each one of our vintages. Now, although we have one distinct demographic profile, we built our glide path to solve for, if you think of a normal distribution, we've built our glide path to solve for the vast majority of participants. So when we take that into account, what we've recognized, and this is actually going to ebb into Britt's question, and I'll answer it momentarily around some allocation changes. Understanding who we're solving for is critically important, especially longevity. Longevity risk is one of the most important components that we're trying to solve for within our glide path. That's number one. Number two, what's contributing to even more increased longevity risk is the fact that we've identified that retirees on average aren't retiring at the age of 65. They're actually retiring at the age of 62. So actually your accumulation period is even more important in terms of ending wealth at retirement, and your sustainability through your distribution period is even more important, because what we recognize is that across the country, more folks are living into their mid-80s. So I say all that to say, we do take into account life expectancy, and our most recent allocation changes, which I'll discuss here momentarily, led us to reinforce our 30-year through glide path. But what it also reinforced to us is that we need a bit more capital preservation the deeper stages into retirement, as folks are living more so into their mid-80s. So we've made some modifications of the glide path, which I'll talk about momentarily. And then from a gender perspective, we don't create two different glide paths for both, women and men, but we do take the aggregate number and take into account, that longer term expectations for longevity or just a pool of the participants that we're solving for. But again, it's not one participant. We want to solve for the vast majority of Americans that kind of sit within a normal distribution.
Could a single participant come to you and say, since I've had some work done, I look so much younger, so therefore I want to be not as if I was 65, but 55. Can people move down, up or down, the spectrum, say?
So absolutely. So a prime example of that is me. I should be in a 2050 target date profile. I am a big time risk taker. I'm not risk averse at all. And every time we launch a new series, I'm invested in our own 2070 strategy. Yeah. So you can off date. So individuals that will be retiring at 55.
You select to them.
Yeah, absolutely.
We would select our as opposed to you. You're not going to drive it differently.
Yeah, we won't drive it differently. You can go in, and if you're going to retire at age 55, you can go in and select the 2025 portfolio, the portfolio that's more aligned with your risk tolerance. So absolutely, it's called off dating, and we see the vast majority of investors don't off date, but the folks that are even more engaged absolutely tend to off date to align their retirement plans or their retirement date.
We use Empower for our plan.
Mhm.
Wouldn't that be their job to explain that? Not your job, right?
Well, I would say it's a combination of factors, right? So not only do you have the great folks from Callan, presumably you have the folks over at Empower as well. And of course, you have folks like Adam to kind of educate you all and your plan participants in terms of what's most appropriate for you. But especially as you're considering individual participants, outside of your life expectancy, there would be participants that will have, maybe an expected inheritance or a greater amount of savings or lower amount of savings. So there are a lot of kind of idiosyncratic factors that factor into a participant's ability to retire. So
Yeah.
a QDIA is meant for those folks that are largely disengaged. So we're going to create a glide path that we think is most optimal for their for the information that we have with them. But of course, they can go into the system and change.
Yeah, no, I get all that. I was just wondering who's communicating with the employees about if you want to be more risk aggressive, you know, you move out 10 years. Definitely.
So I'm looking at Adam, Britt, and the crew here. It would probably be a combination of.
Yeah,
Well, you guys don't
it
talk-
wouldn't be us. We don't deal with the
don't talk to
participants. It's
employees.
gonna be your
You
record
do though?
keeper.
You talk to employees or just Empower? I'm trying to get, is it Capital Group or Empower?
Jim, it's Empower who's
Right.
Okay,
That's what I thought.
Or a benefits department, like,
Yeah.
and they'll, you know, they'll look for flag, like, it's one thing if we're opting for, we've got a lot of time to retirement, we're opting for
Yeah.
slightly more aggressive. It's another thing if you're 2 years out from retirement and you're in that 2065 vintage.
No, yeah, I get
Or
it.
sometimes you see people who like do 2 different target date vintages, which doesn't really make sense. And like the record keeper will look for kind of like red flag moments and then
Yeah.
work with the plan to educate.
One of the things even, and this would be unfortunate, but say somebody, when they did have a plastic surgery to look younger, it ended up that it caused a medical problem and they only had 2 years to live. So with somebody who's like, say, you know, they had cancer, they were told that they had 3 years to live and they might not want to be, you know, they want to maybe be just all in bonds or all, you know what I'm saying? There can be extraordinary events in people's lives that, why I was asking if they could, you know, move down and up or down.
But that'd be up to the employee to go into the Empower system and change their target.
Right, well, it's,
Yeah.
Frank, these are all daily valued mutual funds, so they can do that any day.
okay.
All right, so
Typically,
yeah, sure.
information on people that declare up or down or some way outcomes,
Can you repeat that one more time? I'm sorry.
you know, the people who want to move up or down, whatever it is, how do they typically fare?
It would be really difficult to track at the individual level. Right, like an individual participant within a plan, so I don't think we would have that.
I know,
Yeah,
I'm just
to support
wondering
it.
if you have any outcomes.
Yeah, look, I can speak to myself, you know, being in the 2050 portfolio has slightly lower equity exposure relative to the 2070 portfolio we're in now. So if the markets do well, probably gonna do a little bit better, but if when the markets pull back, we've seen a little volatility over the last few days and probably gonna do
Just
worse.
wondering.
Yeah.
Good.
All right, so I'm thinking about the questions. If we go to the glide path, page 11, this is just a visual illustration of how we think about our glide path. So that shade of blue, those shades of blue that you're seeing, that's the equity exposure. The shades of green that you're seeing, that's the fixed income exposure. So very similar to other glide paths. And for younger investors with high human capital but low financial capital, they need growth in their account balance. So we're going to hold a higher level of equities. But not only are we going to own a higher level of equities, if you take a look at the different shades of blue, that darkest shade of blue is categorized as growth, and those are our growth-oriented equity strategies. So the predominant holdings in these types of portfolios will be some of those fastest growing companies. Think the Mag 7, think NVIDIA, think Tesla will be larger holdings in those types of portfolios. But as we get closer to retirement and we dial down a risk exposure, you'll see this level of blue coming down, which means that we lower the overall equity exposure. But what we're also doing is changing the composition of the equities. So not only are you owning a lower level of equities, the types of equities that you'll own in, for the most part, would be in that growth in income and equity income category. And the companies in those portfolios largely are made up of dividend paying companies. So you'll steer away from Tesla and NVIDIA and you'll own more so the Verizons or the Home Depots, the Procter & Gamble's, companies that, you know, historically paid dividends, and in more turbulent times, they've stood the test of time. And we do something very similarly within fixed income, where even in the accumulation phase, we're going to own a sliver of fixed income. Largely, that's going to be treasuries and mortgages. That's really to act as an equity diversifier, although calendar year 2022, nothing really was diversifying, everything went down, but it really is to act as that diversifier because even in the accumulation phase when markets go down, if you can dampen that volatility somewhat, it's going to give you an advantage when markets recover. But as you can see with these different shades of green, each fixed income objective plays a different role in the portfolio. And then the deeper stages of retirement, that darker shade of green and at the top right, is going to be a more meaningful component of your allocation. And we're going to talk about calendar year 2022, but what we're doing in those portfolios is investing in our most conservative bonds that are higher in credit quality and shorter in duration.
So when you looked at demographics recently, did you kind of shift everything to the right a little bit on this chart?
Yeah, so actually, if you think about this chart, a little bit to the left, so a little bit more capital preservation and deeper stages of retirement. So we're actually going to, and
I thought you were going to say you dialed up the equities because people are living longer and retiring earlier. So we got 20+ years between retirement and death. I think you want to have the equities up, wouldn't you?
Yeah, so the preview is in the accumulation phase, we did dial up the equity exposure. I'll talk about the research, but the decumulation phase in fixed income, we dialed down the equity exposure because you're living much longer and we need to mitigate against sequence of return risk.
Okay.
But just really quickly there, really important as we think about the characteristic of bonds, because all bonds are not built the same. So you can own, a single B company relative to AAA in a portfolio asset allocation model, that those both read as bonds, but we know that they behave very differently. So again, we're going to be a lot more levered to those higher quality bonds. So I want to answer really quickly the rebalancing question, and I'll get into the changes, and we'll talk about 2022. If you go to slide number 14, this is an itemized look through of our glide path. So it's a detailed glide path page, and you'll see the individual underlying strategies that we utilize throughout the glide path. So visually, you can see this kind of glide path within a glide path approach. At the top half of the page, you'll see our growth allocation, meaningful allocation, and accumulation phase. But if you work your eyes to the right-hand side, you'll see the distribution phase is essentially completely eliminated. And the vast majority of your equities will be in this growth and income, equity income category. But similarly, within fixed income, you'll see that we're allocating more to the most conservative fixed income strategies at the bottom of the page, the deeper stages that you get into retirement. So this is our idea of really building wealth and preserving wealth most optimally. When I think about rebalancing, fortunately, we've had some really strong support from committees like you all, consultants like Callan, where we have, really strong flows into our strategy. So on a daily basis, we are actually rebalancing these numbers back to target. So with those net flows, we take those flows and we rebalance them back to the individual mandates. Daily with the flows, yes. So if, when you have a really volatile day, if there are $1 million of flows, we're going to kind of prorate the $1 million of flows kind of back to the target weight. Now, there were points in time in like calendar year 2022 where there was quite a bit of volatility. So we saw pretty meaningful pullbacks. Really, it's just calendar year 2020 during the pandemic where you saw your equity sell off pretty meaningfully. There is some discretion in our rebalancing, and that discretion is super helpful for investors. So at that point in time where markets are trading off, the liquidity really dried up in the treasury market. And what was nice about that market, at least for us, is we were more conservatively positioned within fixed income. And instead of conducting a hard rebalance, we actually were able to go out into the marketplace and trade our bonds at a more attractive price to folks that were looking for liquidity. So largely we're rebalancing at the fund level or the category level, but when there are exogenous impacts, we do have some discretion to trade in a market environment that's going to be accretive to the outcomes for investors.
So if you look at these gray shaded lines on here, those are the target for that particular group of asset funds. How much plus and minus do you go off of those in those times?
300 basis points is kind of like our.
So on the growth and income, that could go as low as 34, as high as 40.
Correct.
Yeah, okay.
But because of those flows, we keep it essentially in range.
Okay.
Britt, does that answer your question on rebalancing? Okay, perfect. How about let's talk about some of the allocation changes since we're there. So on slide 14, these are the allocations as of the year end, but we did announce earlier this year that we were making some modifications to our glide path. It was really 3 research work streams that led us to these modifications that I talked about. The first component is the uncertainty around inflation. That's number 1. Number 2 is the uncertainty around Social Security. That's number 2. And then number 3 were the evolving demographics. So first, when we address inflation, clearly post 2022, it's our view that inflation is not only going to be, just higher in the near term, but we think inflation is going to be stickier over the course of time. So if inflation settles at a higher rate, that means your purchasing power is going to be eroded for a much longer period, even for those younger investors. That's number 1. Number 2, what we found in our analysis, we utilize TIPS or Treasury inflation protected securities in our fixed income allocation. They do a nice job of hedging against inflation in unexpected inflationary shock environments. What they don't do a really nice job of is hedging inflation over longer periods of time. So we're actually going to modestly decrease our exposure to TIPS to help solve for that stickier inflation in the future. And that's going to amount to utilizing more flexible fixed income strategies that have a few more levers to deliver better returns.
Yeah, I agree with you that inflation is going to be worse than the government says. And that, how did you come to that conclusion?
Yeah, so just looking at a variety of different inflationary regimes, I would say, number 1, when you take a look at what's going on from a supply chain perspective in a post-COVID environment, what many corporations, especially the multinationals, recognize is that their supply chains are levered to 1 or 2 countries, usually 1 country. So there's going to be quite a bit of CapEx that's going to be required to help diversify those areas, number 1. Number 2, from a labor perspective, we'll see what takes place with AI. I think technology long-term is going to be deflationary, but in the near term, we are seeing, from look at your non-discretionary buckets like healthcare, housing, food, those categories tend to be stubbornly more inflation, have stubbornly high inflation for a variety of different factors. So that is really that's a truncated way of saying that's what's led us to some of our higher inflationary expectations over the course of time and why we feel the need. That's one of the components as to why we should increase equity exposure in our accumulation phase.
And you shorten duration in your bond portfolio as a result?
As we get closer to retirement and deeper into retirement, where fixed income makes up a greater application, because we want to mitigate against 0% return risk. But I'll talk about that here momentarily because we did make some modifications there. So that's really kind of the inflation bucket, just a lot of uncertainty around inflation and wanting to be able to be sure that those investors that are 25-year-olds, their purchasing power is preserved over the course of time. Social Security, if you take a look at the expectations for the trust reserves, or our expectations is, call it the mid-2030s, there's a possibility that Social Security benefits will be cut. So if your Social Security benefits are cut and you can't necessarily rely on the income that was expected, that means that your defined contribution pool of assets is going to have to work a little bit harder. So that's another contributing factor as to why we're, increasing our equity exposure 200 to 300 basis points in the accumulation phase. And then the last component is demographics. 2 components of the demographics. Number 1, folks are frankly just living longer, right? There's been a lot of advancements in the medical space, and human beings are living longer. Americans are living longer. So if you're a 25-year-old, your life expectancy is going to be longer. You're going to need more growth in your account balance, right? So that's going to contribute to, again, more returns needed in the accumulation phase, but also the fact that more individuals are living into their mid-80s, and the vast majority of folks that are in their mid-80s are usually not going back to work, or the ability to not go back to work. And oh, by the way, because of inflation, your non-discretionary buckets like housing, food, and healthcare is going up. You really need to mitigate the volatility in that part of the portfolio, preserve that capital. So what we're going to do because of those two trends is on the front end, raise the equity exposure. And then in the deeper stages of retirement, we're going to dial down that equity exposure by, 1.5 to 3%, because we want to preserve as much of that capital. So if you're taking on 5 or 6% withdrawals, if there's a strong, if there's a really negative marketplace in the equity markets, that's going to be a double negative. So we want to help dampen that volatility to mitigate that sequence of return risk and mitigate some of the longevity risk in your profile as well. So that's a really high level explanation of some of the changes that we're making. But our changes in our glide path are not based off of short-term expectations. These are strategic changes that we're making for the duration of our glide path. And as new research comes forward, we make those changes ultimately.
It's a big topic. We don't want to get into it in depth. But on Social Security, is your assumption that there's a possibility that benefits will be reduced for people, let's say, under 50, or across the board, or retirement dates should be extended, pushed out? Where do you?
So it's interesting. I wish Jason Bortz, who's our he's on the Hill all the time with the Department of Labor, really advocating on behalf of investors and for the industry. So to be in 2035, those folks that will ultimately receive their benefits then. So folks, you could see how meaningful is the reduction. Is there going to be change in legislation to save it? The way that we think about it in our portfolios is not necessarily make the call that it's going to happen. It is going to happen 100% or not, but the fact that there's a probability that it happens leads us to making sure that we're allocated appropriately if that ultimately takes place. Will the government allow that in 2035? Who knows who's going to be in the administration? I don't know if anyone on their watch wants to see Social Security benefits go down.
Going to have to,
right? But we all know the numbers. We look at the deficits, especially within the trust reserves, and there needs to be some sort of a change, right?
But you haven't, coalesced around a particular expectation.
Not yet. I mean, we've done. There's a lot of research. There's some scenario analysis, but again, we know how fluid the marketplace can be. But again, the expectation is that there absolutely is some doubt in the expected Social Security benefits, which we had to adapt for in our glide path. All right, calendar year 2022. Let's look at slide 24. So we can take a look at. I find this to be one of the most interesting slides because it looks at our strategy in down markets. And we know that when you receive calls from participants, it's usually not in up markets, it's in down markets, right? So we're looking at the 3 bear markets and the 4 correction periods over the essentially 19-year track record of our glide path. So I want to focus in on the bear market of 2022. As a reminder, equity markets were down, a little north of 25%. Fixed income markets were down. Double digits as well. Now, if you take a look at the pattern of returns here, you'll see 2 things. You'll see the accumulation vintages, orange and red, which indicates 3rd and 4th quartile return rates. In the near dated vintages for those individuals that are really focused in on, downside protection, where we're focusing in on downside protection, you'll see, top percentile investment results. So I think your question is probably on the further dated vintages. So let's start maybe there. So when we look at the further dated vintages in that 3rd and 4th quartile, our growth factor exposure, which essentially is a fancy way of saying the high multiple, fast growing companies that were longer duration in nature, when the Fed raised rates because of, to combat inflation. I mean, all the central banks across the globe really raised rates to combat inflation. Many of those companies that had higher multiples were absolutely decimated. So in our growth oriented strategies, we had higher than our historical growth-oriented exposure, which led to a pretty meaningful drawdown in a handful of names. So I think back to that marketplace, international traded off pretty meaningfully, but we had companies like Shopify, we had companies like Mercado Libre, strong long-term holdings, but in that time frame, they were just absolutely hit pretty hard. But in the near dated vintages, as we think about our glide path, it's really about the pattern of returns. There will be bull markets where those near dated vintages, you know what, they're going to lag, many of our peers that are taking on much more growth exposure. And then that 65-year-old portfolio, they're going to own a whole bunch of high flying tech companies. But what do we want to do in those vintages? We want to produce income to help sustain withdrawals, and we also want to mitigate volatility. And what this page really highlights is our ability to do that. So getting back to your short, are you shortening duration as the fixed income portfolio goes deeper into retirement? You see first percentile rankings in that 2010 and 2015 portfolio. So these are portfolios, call it 10 years into retirement. The fact that we had higher credit quality when equity markets were down, so the main credit on the fixed income side would be credit spreads would be widening. But remember, duration is what really hurt you in that environment. So the fact that we were shorter duration relative to our peers helped meaningfully in that time frame. So it really kind of brings it home in terms of how we think about the totality of, building our glide path, but then also for committees like you all, the predictability of those returns.
And if you looked at the 2055 to 2070 targets, in 2022, they probably bounced back pretty well the following year, right?
Yeah, so if you'll see that in the 3-year or 5-year number. So if you just go to slide number 26, this kind of brings to life why, when you look at returns, especially in the near terms, you can have near-term volatility. You have a good quarter roll off or a bad quarter roll off. It's really about the consistency of the results. But as you can see, even incorporating that bad 2022 year in the, kind of 5-year returns, you're seeing a lot of dark shades of green. So if you look at the 1-year number and the year-to-date numbers, the same period, you'll see that we averaged in the 23rd percentile, top quartile rankings. But at Capital, we don't gauge our success on a 1-year basis. It's really about extending those timeframes. So look at the 3-year, 5-year, and 10-year results, really strong return rates. But I would tell you that only gets us in a room. And the reason that you hired us isn't purely for our returns, because you can just go with a super volatile strategy. It's how we've been able to deliver those returns. So if you look at the standard deviation ranks in that middle column, you'll see largely top quartile risk results. So we've been able to generate, industry leading returns with a moderate to conservative risk profile, which ultimately leads to industry leading Sharpe ratios. So not a typo here, although the last time I was here, I may have said, I don't know how much better our results can get, but it's really about our pathway to getting there. It's about the investment process, the core design principles that set our glide path apart, and then ultimately the pattern of returns that we're delivering for our investors.
Okay.
I think we're just a couple minutes over 30 minutes, but happy to answer any other questions you guys might have, as long as you want.
Do you know offhand what your, so we got 25 funds here that, how many, what's the turnover in the portfolio managers across the whole group that we're invested in?
Yeah, so we take a look at turnover at the committee level. So the committee level on slide number 10. So these are the asset allocators making the decisions. At the Capital Group and our underlying strategies, we employ this multiple manager system, the Capital systems. And the beauty about that multiple manager system is that when you're utilizing multiple managers on a singular mandate, you really help solve and absorb that key person risk. So we regularly expect portfolio managers to roll on and some to roll off. So usually if they're rolling off, oftentimes they're retiring. So we like to stagger the experience levels of our underlying strategy. So we've had quite a few retirements, but if you look at the underlying 28, 29 strategies that we're utilizing, I would say the turnover isn't, really meaningful in terms of how we think about impacting overall returns.
So we don't have specific numbers, but I'd say in general, in the industry, Capital Group's turnover in the investment team is significantly lower than the rest of the single digits.
Looking at Paul and Britt, Eileen, anyone else? Any questions?
None for me. Thank you
for
the review.
Well, thank you again for the time. We really appreciate it. Always happy to questions. Thanks to you guys.
Appreciate it.
Again, we really appreciate you the time and your partnership.
Well, good job.
Yeah.
Yeah, how do you have to carry the ball? What do you, why do you even bring him?
I mean, he actually brought me some cookies, which is awesome. We have to FaceTime my daughters on the way
You
out.
know, I mean.
And say like, Adam brought cookies, so I'm bringing them home tonight.
You gave an excellent presentation. You answered all the questions.
I gotta make sure he gets here too, as you mentioned the off day thing, Jeb's actually 80 years old. But again, thank you so much.
Thank you.
All right, that's awesome. Thanks for your conviction in us, and looking forward to being back again next year.
Yeah. Good seeing you, Chad.
Rick, thanks a lot.
Bring the cookies.
Oh, that's not my phone. Oh, it's just me. Thank you.
Just make sure I didn't pick up your phone.
Really one.
Okay.
I mean,
The numbers are impressive, that's for sure. You know, and when you look at page 26, that definitely is impressive. I wonder, you know, look at our numbers overall versus these, you know, it's actually interesting to see that.
Yep, good job.
Totally different approach than than how we look at it, you know, in terms of our, you know, our approach that we're managing versus what they're doing. There's some
Correlation, there,
Yeah,
you know,
there
each of the
really is.
vintages is a diversified portfolio still of assets, right?
rebalancing every day. I don't know, it's hard to imagine that.
Yeah,
They call computers.
Yeah, yeah.
Just push a button, boom. Yeah.
Impressed them.
on page 12, the 2055 fund is pretty aggressive. Amazon, Meta, Alphabet, Taiwan Semi, Nvidia.
Well, that's great that they want to crank up the equities, you know, earlier, you know. And that's 25 years away, so those people are what, 30 now?
Yeah.
All right,
The other items we have on the DC agenda is to go through the fourth quarter performance report. So we can do that quickly, and then we also made similar changes to the IPS, which you can talk about afterwards.
Yeah.
Okay, so looking at, this is for anybody who's got the hard copy, this is in section 3. Just as a reminder, Q4, this is a while ago, but we had a pretty long government shutdown. We had a spike in job cuts. Consumer sentiment was hovering near record lows. And all of that aside, risk assets still maintain their upward trajectory. US international equities were both up quarter to date, returns of 2% and 5% respectively. And fixed income was also up about 1% for the quarter. So if we turn to page 36 in the performance report, we'll start just taking a look at target date funds, and keep this brief because we just obviously heard from Cap Group. But again, kind of modest rally in global equities and bonds really helped drive absolute returns in the fourth quarter across all the vintages. Absolute gains ranged anywhere from 2% in 2010 vintage to almost 3.5% in the 27 vintage. All of the vintages delivered results that were in line or slightly ahead of their respective custom benchmarks. Contributions in terms of the asset allocation muted across the glide path. Modest equity overweight that added value, particularly in MSCI ACWI. And then fixed income and equity, non-US equity security selection was really strong. As Cap Group just mentioned a few minutes ago, peer group rankings for the quarter were also strong, with every single vintage ranking in the top quartile. And those rankings look really strong across every single annualized time period, with every vintage ranking above median for the 5-year period, and 8 of the 12 vintages ranking in the top quartile for that 5-year period.
remind me again, what's the difference between the first and second row on these items, in all these rows?
The American fund, that's their benchmark. And then this is the Callan target date sort of like the median target date fund for that
I know what
particular
yours are,
vintage.
but you look at the first one, we got American Funds target date 2010, then you got a day of target date 2010.
Yeah, so that's the benchmark, the second row.
How do they create the
index.
benchmark? How do they
That's-
do
The
it?
custom benchmark,
That's their benchmark.
that's their benchmark, right?
Okay.
And that, I mean, there'll be more information inside of their presentation on
Yeah.
how they go about creating that.
So 2%, whatever it is, like little the percentages in the for each of the categories, basically.
Yeah, it's kind of in, the same way we construct like a total fund benchmark
Yeah.
for the pension, for
They
instance,
always
right?
beat their own benchmark. Gee.
Right, there's like you have
Not every provider can say the same.
for every single one of the asset classes that is present
Yeah,
in that particular vintage, they have a target weight,
yeah,
and then it's a matter of whether or not like
they strap it there.
it bubbles up into the total
This
benchmark.
is them tinkering with their the mix.
Yeah, so they're making a determination, and the benchmark construction itself, so they're saying, okay, 2% of the benchmark, I'm just thinking hypothetically, is small cap, right?
Yeah.
And then it's a matter of, like, within small cap, did you, like, what the index was, the Russell 2000, that 2%, did what you do in the portfolio in terms of, like, your stock selection, active allocation weights, help or hurt versus that 2%.
Yeah, so they,
And then putting it all together to find,
that's what, yeah, okay.
right. So there's a lot.
How's your benchmark? How do you get yours? Yours is the average of all target date funds for the,
That's right.
That's
So,
yours.
yeah, and
that's weighted average is based on the the assets they're managing?
no, it's not weighted average. It's just strict, like, pure performance.
Yeah.
So we're saying we don't care like what your benchmark is for that 2010 vintage.
Yeah.
What was your absolute number? And that's active and passive, by the way.
Yeah,
And so, like, did you do better than that median target date fund for that particular
And then
vintage?
just numerically sum all those numbers, or I think you were asking, is it a weighted?
weighted average.
Weighted average of that,
those funds.
Oh, yeah, to get to like a median.
Yeah,
Or is it
Right.
just a simple numeric
yeah.
Well, it's more simple numeric. I mean,
average? Okay, yeah,
Yeah.
not weighted average, yeah,
Right. So,
good.
so that's how we get to that. Looking at the passive funds, all of them continue to track the benchmark pretty tightly. This is on page 37 now. Over the longer term periods, we're always going to see a little bit of deviation in the shorter term, particularly with international equity. There's impact from fair value pricing processes. Not to go down a rabbit hole, but it's really kind of the adjustment of prices for non-US equities that changes their fair value with respect to, like, when markets close in their local currency versus the US. Those wash out over time. So again, short term, it's like deviation, longer term, not an issue. So passive looks good. Maybe just turning to a couple of the active components. So first is JP Morgan, the equity income. This was actually an underperformer during the quarter. They commented on really narrow market leadership, and they were just saying that that was driven by characteristics at odds with their more conservative philosophies, and that posed a challenge for them during the quarter. They kind of highlighted information technology as the top performing sector, and they had pretty limited exposure to some of that high growth and low yielding stocks like a Micron Technology, for instance, and that impacted their results. The market's narrow focus on a small subset of winners. They think, though, it has actually given them opportunity to invest in some pretty high quality companies that are right now on sale, i.e. value. So they do see, an opportunity, even though from what hurt them going forward, as an opportunity set for them to pick up some companies at more discounted levels. Maybe just changing gears to one that did really well, MFS large cap large cap growth, right beneath it. So they kind of, on the flip side, it was about what they didn't own. So they didn't own shares in enterprise software products. If you recall, like, software has taken a big hit as of late because of the perceived AI impact down the road. So that really benefited relative returns. And again, the enterprise software companies really struggling with margin compression from what they're calling like workplace transformation costs in the face of AI. Particularly not owning names like Meta, right?
Oracle.
What's that?
Oracle.
I'm trying to, did they own? I'm not sure if what their exposure was to Oracle, but it certainly would make sense if that was one of them. They also noted that not owning shares of Netflix benefited them, slower subscriber growth. Also, that company, they were at the time embroiled in an acquisition with Warner Brothers that's since fallen apart. Now they did get a nice like $3 billion breakup fee from that. So yeah,
So really $20.
maybe they knew better than us, but at the time it was good to not own it. And then lastly, I was just going to call out.
Maybe just to add one
Sure.
comment on MFS. So the Russell 1000 Growth Index, as you all can imagine, the concentration of tech and AI stocks in that index has driven performance really through the roof over the last 3 to 5 years. MFS is going to be a more diversified approach. So in a market like that, when everything's going straight up, we would expect them to lag. The strategy should really do well in the markets we're seeing now, or broadening out of leadership in the index, as well as protecting on the downside. So I just wanted to highlight that in terms of longer term performance.
Yeah, thanks, Brett. TCW MetWest, the Total Return Fund, they gained about 1% during the fourth quarter. Ag was up about 110, so they were slightly behind. That being said, they did outperform for the 12-month period by about 50 basis points. I mentioned a little bit earlier in the meeting that the overweight to duration was finally a tailwind for them. In prior years, it had been a headwind. They also, were supported by a nice overweight to the agency MBS. It's one of the top performing sectors for the quarter as well as the year. So diversified in terms of the contribution to return, and nice to see that duration overweight is finally adding as opposed to detracting. So all in all, DC plan is looking really good shape, in large part, frankly, because of the target date funds doing such a stellar job. So no concerns from our end.
How about GW&K? So they're only up by 40 basis points this year, but the last several years they've been lagging their index.
Who's that?
GW&K, small mid cap.
So Jim, if you remember our discussion the last couple meetings about the rally in small and mid cap stocks, unprofitable, highly shorted companies, that directly relates to GW&K's performance over the last year.
Yeah.
So they're not going to own a lot of those names. And we saw a lot of small and mid cap managers get whipsawed because of the momentum driven market. I think over long periods we would expect that to subside and their quality stock picking to be rewarded.
Right.
Yeah, and if you go to page 39, Jim, where you can see the calendar year performance, granted, that they were still behind in some of those 24, 23, but so much of the annualized time period you were just looking at is really coming through as a result of 2025.
Yeah.
And the market environment Brett was just speaking to.
Okay.
That's really weighing on it.
All right.
Questions or comments on the performance report? Okay. The last item we have is in section 4, which is the revision to the IPS for the VC plan.
Yep.
Very similar in nature to what we talked about earlier on the pension, but page 4, under the section of investment managers, we added language talking about the types of vehicles that the plan is able to invest in. Most notably, per legal's request was making sure we have information that says that they are eligible for pooled vehicles. So I don't know if you want me to read the entirety of it out loud or if everybody can see it and is comfortable with the revisions that we're recommending.
I would make a motion to accept the changes as proposed to the
Earl second.
policy manual.
Oh, any discussion? If not, all in favor?
Aye.
Opposed?
Done.
Great, that's concludes
it?
our, yeah.
Okay, any other business? If not, a motion for adjournment?
Move to adjourn, Earl.
I'm still gonna second.
Okay, everybody's gonna second
All
it.
right.
All in favor? Aye.
Aye.
No. No, I'm telling you, as soon as 6 minutes over.
Thank you.
6 minutes over.
Yeah.
Have a nice night, everyone.
You know, it is impressive because
Thanks, Brett.
Thanks.
they're